good evening. A very warm welcome to our audience from India and overseas. Our PIC conversation today features three distinguished guests, Dr. Prakash Hebalkar and Dr. Subhashish Gangopadhyay, who will discuss the role of digital currency. This will be moderated by Dr. Ajay Shah. It is my great pleasure and honor to introduce our event speakers and chair. Dr. Prakash Hebalkar, based in California, has been a corporate strategy and public policy consultant for over 25 years after pioneering the Indian software export industry in 1979. He founded and directed the product development group that created Easy Deal, an online foreign exchange deal room, which was the first packaged software exported from India. He has been a board director and senior advisor at M&M's Mahindra Life Spaces, Blue Star Infotech, CanBank Venture Capital India, and IDFC Private Equity, amongst others. He started his career as an inventor and scientist at IBM Research after obtaining a Doctor of Science in Computer Science from MIT, USA, and graduating as topper in electrical engineering from IIT Powai. Dr. Hebalkar formulated and proposed trade policy reforms that were announced in 1991 for Exim Scripts, pioneered and promoted software policy as a reversal of the electronics policy favoring hardware in the 1980s, and developed the Indian position on semiconductor at WIPO, focusing on copyright instead of layout patents. More recently, he proposed revisions to the Science and Technology Innovation Policy through the Pune International Center, PIC, of which he is a founder life member. We are honored to have you, sir. Dr. Subhashish Gangopadhyay currently serves as the Research Director of the India Development Foundation, the Dean of the Indian School of Public Policy, Professor of Emerging Market Finance in the University of Groningen, Netherlands, and Visiting Professor in the University of Gothenburg, Sweden. He has been a member of the South Asia Chief Economists Advisory Council of the World Bank and of the board of the Center for Analytical Finance at ISB. In 2008, the year of the financial crisis, he was the advisor to the finance minister in GOI. More recently, in 2018, he was a member on the high-powered committee on the use of defense land. Dr. Gangopadhyay was the founder chief editor of the Journal of Emerging Market Finance and has published widely. He earned a PhD in economics from Cornell University, USA, and a bachelor's degree from Presidency College, Kolkata. Dr. Gangopadhyay, thank you very much for joining us. Dr. Ajay Shah studied at IIT Bombay and USC LA. He has held positions at the Center for the Monitoring of Indian Economy, CMIE, Indira Gandhi Institute for Development Research, IGIDR, Department of Economic Affairs at the Ministry of Finance, and the National Institute for Public Finance and Policy, NIPFP. He is now part of ex-KDR Forum and Jindal Global University. His research lies at the intersection of economics, law, and public administration. His second book, co-authored with Dr. Vijay Kerkar, In Service of the Republic, The Art and Science of Economic Policy, featured in Bloomberg's Global 2020 Best Books on Business and Leadership. Dr. Shah, we are delighted that you could join us today. Before we move on, I have a couple of brief housekeeping announcements, please. Audience audio and video has been disabled. Please send us your questions in brief in the Q&A box. Our speakers will try and respond to them as many as possible, time permitting. We are recording this event, which is also being broadcast live on the PIC YouTube channel. And now, without any further ado, let me call upon Dr. Ajay Shah to offer his introductory remarks and then invite the speakers to begin their discussion. Over to you, Dr. Shah, about 5 minutes, please. Thank you.
Audio.
Dr. Shah, we can't hear you.
Yeah, thank you very much, Shilpa. It is an honor to be here in this PIC meeting, and in particular, to be with my respected friends and colleagues, Subhashish and Dr. Hebalkar. There are no better minds than these to illuminate the questions at hand. Before they start, I would just like to pose the questions that we should think about, that we should contemplate. There is this enormous new important field starting from an amazing paper by a potentially apocryphal person, the Satoshi paper of 2008, which led to Bitcoin, where the dream, the philosophy, the concept is can a concept of money be created without a state? Okay, so this is the remarkable idea that can there be a way in which we humans are able to do transactions on each other and make payments to each other, and there is a sound money which does not require a frail human institution of a central bank. Okay, this is the concept that Satoshi and many others tried to build. Now, from an Indian perspective, as I see it, there are three aspects to this story. First, if the Bitcoin market cap has crossed $1 trillion, if hypothetically there had been a bunch of Indian people active in this, then maybe $100 billion of wealth might have come to India, just as a part of being an intensive part of this journey. Second, the greatest industry of India is the industry where Prakash Hebarkar was a pioneer, is the IT industry, is the software services and products industry, where India builds and contributes to the requirements of the whole world. To the extent that the requirements of the whole world have gone and will go towards cryptocurrency, it is good and important for us that our young people should be living in the modern world. Our young people should be immersed in all the new things happening in the world of science and technology so that they are able to fully imagine and participate in the global landscape. Third, in India, we have actually always had one alternative to the Indian rupee, and that is gold. We've treated gold as an escape valve, that when man-made money functions badly, when there is high and variable inflation in India, we have fallen back on gold. So, potentially well-functioning cryptocurrencies are a natural extension of the Indian household mania for gold. And is there a role there? There is some time ago, the Reserve Bank of India came out with a very sweeping ban on cryptocurrencies in India. Then there was a very remarkable development that at the Supreme Court, the ban was struck down and some very important new legal doctrine is evolving on this subject, which is the concept of proportionality, that a state agency cannot just do whatever they want. That if a state agency that is charged with writing law, namely a regulator, wishes to undertake an extreme action like a ban, they are obliged to demonstrate in writing that there are harms, that there are very large harms that justify the extreme step of a ban. So the Supreme Court said that RBI has not demonstrated proportionality. RBI has rushed to the most extreme tool, namely a ban, while not demonstrating that there is any significant harm. No other civilized country other than China is doing these kinds of things. So this is where we are in the Indian debate, that what is the world of cryptocurrency to all of us? Is it important to us? Is it a passing fad? Is it a fundamental conceptual mistake? Is it something deep and powerful? Is it important for us as an IT superpower? Is it important for us as an alternative to gold? I'd like to first turn to Dr. Hebarkar. Could you please give us your initial comments on this subject? And then I'll turn to Shubhashish. And then we'll have some time for discussion. As Shilpa has said, please put your comments into the chat box and I will intermediate them, carrying them to Dr. Hebarkar and Shubhashish. Dr. Hebarkar, over to you.
Thank you. I'm trying to share my screen. Are you able to see my screen?
Not yet, sorry.
Not yet, sir.
I'm having trouble with this.
Would you like to send it to me by email and we can broadcast it while you speak?
Yeah, I could do that.
Okay.
I usually can share the screen, but I'm having difficulty with that.
I think the host has to give
You need to
screen
permit it.
sharing. Yes, the host has to give you
Amresh?
screen sharing rights.
Yes,
Yeah, the
ma'am.
host is not giving me the right.
No, no, ma'am. The rights has been given already.
Well, then I should be able to share the screen, but I can't.
Now, sir, I have made you co-host. Please try again once.
No, it's only allowing me to broadcast photos in Gmail, but not PowerPoint. Shilpa, have you received it?
Not yet, sir.
It's gone. I apologize for this difficulty. We should have tested this earlier also. Sorry.
So would you like to start speaking, and as soon as we receive it, we'll join with the PowerPoint on.
I want to first make sure I get it before I start.
Okay, I think it's just come in. Yeah.
Okay, great.
Okay.
Okay. I was hoping Ajay would also. Sorry. Is there a problem?
Yeah. Sorry to interrupt. Amresh, Kiran, I've sent it to you. Can you please just
Yes, ma'am. I will do it. I will do it from my
yeah,
side.
please open it and
So I was hoping Ajay would also introduce what cryptocurrency is. Can I take it as a given?
You should perhaps do 5 sentences.
Okay. In essence, the concept underlying it is the ledger. And the cryptocurrency is just a sequence of records of ownership of what is conceptually a coin, or which they like to think of as a coin, but which is really a bunch of bits in a record, and the ownership of that. And everything depends very heavily on cryptography. And cryptography, one of the essential principles of cryptography is it's computationally very hard. So it takes somebody's mic is on, so I'm getting feedback. So because it's computationally hard, it's a protection to make sure that only those who are equipped can add to the ledger. And it depends in a distributed fashion on consensus to confirm whether the record of the ledger that you're looking at is a valid one or not. So in a few sentences, that's the concept behind it. So the first thing, as I said, these are pseudo currencies. They may have the name coin in them, but they are only a coin in name. But those bits and the ledger of ownership that are represented are sometimes treated as a tradable security that you buy, like a bond, or it's a commodity and you buy quantity of it, or like tulip, it's just a flash in the pan that sometimes has value, sometimes has a lot of value, sometimes very little value. So the reason I state that is you'll see later on when I come to cryptocurrency what the regulatory concerns are. So there's Bitcoin, Satoshi paper's first outcome. Then there's Ethereum, which is quite widely used, but there are hundreds. In fact, last count, I think it was 6,500 of those. There's a kind of quote coin, I'll use the word coin without the quotes now, which is backed by real money. And these are called stable coins. And the money that is backing it, which is the subscription amount, so to say, provides float for the exchange to invest and make money on, in addition to their usual fees. None of these pseudocurrencies are currently regulated by any government. And in fact, it is significant that Bitcoin itself is registered in St. Kitts, which is one of those tax havens that is sometimes in the news and was in the news with VP Singh and Narasimha Rao. One of the things about this is because its value is determined purely by supply and demand, and the supply in many cases is not controlled. Bitcoin has an algorithmic limit on it of 16 million. Ethereum has an annual issuance limit, but most of them have no limits. So their quantity is variable. In any case, not all of the coins in the Bitcoin limits are issued either. I'll come to that a little later. So the price is determined by the market. It's pure demand and supply. So the market value of a Bitcoin or any other similar coin varies wildly. And Bitcoin has gone from a few cents to $50,000 and back down to $30,000 currently. And it's very volatile, which is good for derivatives traders, bad for those who want to use it for trade in goods or services because you don't know how many are going to be required. It's like a hugely fluctuating exchange rate. Are these pseudocurrencies trustworthy? That's a huge question mark. And currencies in the real sense depend heavily on trust. So that's one of the major concerns in the whole process of regulating or permitting or using these currencies. Next slide, please. Okay, now, in spite of all of this, they can be bought and sold on exchanges in a number of countries. And they provide a basis for value exchange because you can trade them. If somebody is willing to accept them in exchange for goods or services, then they provide a basis for trade. And in that sense, it's like a pouch of diamonds or a gold biscuit or hawala, which is, I trust you, therefore I will give you the money. And you trust somebody else who will give the other party the money. And in a sense, that's really what is happening behind very conceptually. The other people who love pseudocurrencies are money launderers and ransomers because anonymity is one of the features of pseudocurrencies. And yet, unfortunately for them, the FBI did retrieve most of the payout of ransom made by Colonial Pipeline. Not all of it, because some of it had been dispersed, and there are some mechanisms that have evolved through technology, which basically break it up into a number of pieces, intermix it with somebody else's, and disguise them. Tesla, for a while, was accepting them if you wanted to buy a car, then they stopped. And now they're saying we might accept them again. Some payment firms like PayPal started selling and storing pseudocurrency, Bitcoin in particular. But they recently announced that they'll also accept them in settlement. Visa also announced very recently, last week, that they will work with the stablecoin USDC, which, if you recall, was the one that was 1-for-1 with the dollar. And it's one of it has currently 160 normal currencies that it handles. This will be one more beyond that. To understand their role, in 2019, the global trade in goods alone was 19 trillion US dollars. Cryptocurrency, the total value of all the cryptocurrencies issued is of the order of $4 or $5 trillion. So it's currently a very tiny percentage, but there are trades happening using Bitcoin. Next slide, please. When it comes to investors, that's another class of people who like to own pseudocurrencies. And what has been driving them is two things. One, they used to hold gold because it was supposed to be an inflation hedge. But the volatility in gold prices has been huge. In 2020, it went up substantially because people saw that as one of the few things that would hold out in a crashing market. It's since moderated, but as you can see in that graph, the fluctuations are huge. Next slide, please. So investors are saying that's one factor. The other factor is interest rates on treasuries and government issued debt went down close to zero in the USA, negative in Europe. So those who had funds like retirement funds or government sovereign funds were looking for ways to earn income on them. And they thought by that, at least a small part, they would dip their toes in the water and start buying Bitcoin because it was appreciating at that time. So if they couldn't get dividends or interest, they could get appreciation by selling them at a good point. Major investment banks also have started showing interest in dealing with them for clients and perhaps for their own treasury operations. Some pension funds are doing that. Some corporate treasuries like Tesla itself. Tesla has invested a certain amount of its liquid funds in Bitcoin. Some others are planning ETFs. One of the problems with the $36,000 coin is if you don't have that kind of money, you can't own it. And the other thing is if you don't think Bitcoin is the greatest thing, but it's one to have in your portfolio, but there are 3 other coins you want, like the ones I mentioned, then you would like an ETF which offers you a portfolio. And you can control the beta of that portfolio by the mix that you use. So those who are worried about the stability of or the volatility in a coin may feel better when there is that mix. We seem to have lost the slide. Would you bring it up,
Amrish?
please?
Amrish? Kiran, if you can hear me? No, I've lost. Let me call them.
Okay. This is the chart of the price of Bitcoin. At the point that this picture was taken, it was 31,000 odd US dollars, which is what I was saying. Bitcoin is also traded in, futures are also traded. The Chicago Mercantile Exchange offers a trade in Bitcoin futures. Next slide, please. Okay, coming to real digital money, if you want to call it that. Central banks, regulators of securities like SEBI or SEC in the US, commodity market regulators like the CFTC here. There is a bit of a struggle between them. There's confusion because we don't know if it's a fish or a fowl. We don't know if it's a security or whether it is a commodity or what it is. And so jurisdictional conflicts are also there, and that hasn't yet been resolved fully in any country that I'm aware of. The other thing is central banks also worry about loss of control on the money supply. If too much of the trade moves to these other coins, then the role of the dollar in trade begins to be affected, and also in domestic exchanges. And so their ability to control money supply and influence it through interest rates begins to be somewhat threatened. In the worst case, they fear that fiat money could be substituted completely. If there are enough people who believe that they would rather hold Bitcoin than the dollar, then the role of the dollar in their life certainly is minimal or absent. And if their numbers begin to grow, then that becomes the same kind of concern. But there are experiments on. There are sandboxes and experiments that are taking place in a number of countries. I listed just 2 or 3. There's one being tried in Shenzhen, which is between Shenzhen and I think one other city nearby. Bermuda has the sand dollar, which is for use only in Bermuda. The East Caribbean group has a common digital currency that they're piloting with. The main attraction in all of these is low overhead in transfers. Current transfers, as I'll elaborate a little later, take a lot of time, involve significant commissions, require settlement balances at both ends of the trade, have KYC certifications, anti-money laundering certifications, and other things in each jurisdiction. So there's quite a bit of overhead associated with money transfers, which are avoided in this mechanism of the digital currency like the Bitcoin. Next slide, please. Okay, now currently in money transfers, if you do it through SWIFT, first you go through the domestic clearinghouse between the remitting bank and the participants in the clearinghouse, the participants in the SWIFT network, the respondent bank, which has the overseas balances, the Nostro and Vostro accounts, the SWIFT switch itself, the SWIFT member bank, if they are not the same as the respondent bank, the receiving country, the same sequence backwards. And sometimes these transfers take days, 2, 3, 5 days, depending on which country you're sending to. And they involve, as I said, netting accounts with the central bank so that there can be a settlement of the net transfers in each direction. And the exchange rate in those days can vary, sometimes drastically, depending on what's happening in the marketplace and whatever worldwide incidents are affecting the marketplace. So you think you sent $1,000 to Norway, and instead of getting 8,000, you suddenly find they get 7.5, or they get 10, or well, 9.5 probably, or as little as 6, depending on the fluctuations that take place in the market. And maybe the difference is only in a few Norwegian kroner. The digital pseudo currencies, because they are connected internationally through the internet and multiple exchanges like Coinbase, Binance, and others, the transfers in that sense are instant because they're simply change of ownership. And the value of that only becomes an issue when you want to convert it into fiat currency in the respective countries. But pseudo currencies also have performed badly in times of busy trading. There have been incidents where the exchanges were backlogged. There were delays of many hours. Those who had short positions found themselves in trouble. Those that were, again, hit by the volatility in the valuation got hit by the volatility, and therefore the exchange rate equivalent of confusion or loss. And these exchanges also involve huge amounts of compute time because, as I said, cryptography depends on computationally hard problems that require a lot of computing power. They require, therefore, a lot of energy. And depending on the number of trades being executed, there are backlogs and resources become a constraint. Next slide. So considering all of this, the objective of central bank digital coins, when and if they come, are the following. First, their concern is always to maintain control on issuance and supply. And so in the context of cryptography systems, these are permission systems, meaning only those who are permitted to participate can participate. Unlike permissionless systems like Bitcoin, where anybody can trade on them. The second thing is they want to keep them amenable to interest rate influence. That's one of the few tools the central bank has to influence money supply. And so they don't want to lose that tool. Otherwise, they lose control over inflation, which is their primary objective and responsibility or target. But at the same time, they want to facilitate fast international transfers. So they want to overcome all the current overheads and delays associated with the centralized SWIFT switch and the trade of supply chain at either end that actually the money flows through. The other thing that is currently missing is what is called pay-to-pay control, which means that you pay your bank only if the recipient's bank pays him. Currently, these are all one-way transfers, and you give your bank and they transfer it to the next bank in the chain. And to pursue that whole chain to find out where your transfer is lying and to reverse it if there is a problem is a very difficult and tortuous task. So there is what is called an objective of pay-to-pay or pay versus pay, PVP, as the Bank of International Settlement calls it. That is a desirable objective for central bank digital currencies. And yet they want to maintain close cryptographic control. If you lose cryptographic control, you lose control over the whole money supply. They want to maintain KYC. They want to make sure that the participants are identified and that you don't have money laundering taking place. They're okay with small transfers like cash, saying anonymity is okay over there, and we don't really care to track cash. But certainly large transfers we want to maintain control over. And non-issuing countries, the ones that are late in the game or that don't understand the concept and the regulation and the control sufficiently, they worry that their currencies will get substituted because that digital currency of another country is available everywhere in the world, including in the country that is not participating or not issuing. And yet it is usable in transfer and investments, and it can participate in the upside in capital markets and all of those good things. They're worried that there will be a complete substitution effect. Now that has happened in some countries when the currencies were completely debased. The Weimar mark was one of them. This has happened in South America, it's happened in Africa. So it's a very real fear. It's not just an imaginary fear. And fear of control is a big worry in all administrations. Next slide, please. The other concern has been the divergence of monetary power and economic power. What's happened is there are three things about the US that are very important. One is the largest source of liquid and available convertible currency capital. So it's the largest capital markets, the most liquid capital markets are in the US. It has 90% of international trade is currently denominated in USD. When the Bretton Woods Agreement was signed, it was a very low percentage, but it's just been climbing every year, and it's currently around 90%. On the other hand, you look at a country like China, which is one of the major growing economies and now currently the second largest, soon to be the largest. Somebody said 2040, you may have your own target date. And so they feel, they're feeling their oats, you might say. They feel we are so large, why is it that we have no control? Because in spite of all of this, the USA can impose controls. They can put control capital market access and say you can't list in the US, which is what they've done currently to a number of Chinese companies. And there is a fear it can be done to all of them. China is trying to reciprocate the other way. Trade has been restricted. Individuals in other countries have been restricted from trading in US currency. And so all of these sanctions are a power that the control of the largest markets, the denomination of trade, and all of those other benefits of that particular currency enable. So if you want to get rid of those unilateral sanctions, you have to find a solution. It's not clear what that is. I'm throwing out an idea which will probably get laughed out of court. But what we may need is the equivalent of a digital special drawing rights analog that becomes a medium of international trade and investment. But that's at best a dream. And there may be practicality issues because when the SDR was first introduced, it ran into some of those issues. And that has resulted in the SDR being a small part of most countries' reserves. Next slide. So the question you have to ask is, okay, so these are the concerns. Those were the benefits in trade and investment. So what's coming? Here are two examples. The United States Federal Reserve, recently there was a hearing of Jay Powell in Congress. And he said, cryptocurrencies have completely failed to become a legitimate payment system. And central banks could step in and develop digital versions, but Powell thinks it's legitimately undecided at this time about the benefits of doing so. In other words, to use his expression, we are not yet thinking about implementing them. But the Fed will put out a report on the digital dollar around September, which is the research group inside the Fed. The European Central Bank is yet to begin a study. That study was to begin on a digital euro this week. So they're a long way off from implementing it, but they're being compelled, pressured, incentivized, whatever you want to say, to look into it because that's something that seems to be inevitable at some point of time. Below that, you'll see on the slide a quote from one of the founders of the largest crypto exchanges, FTX. Oops, previous slide, yeah. Who referred to Dogecoin, which is a joke. Somebody got so disgusted with the number of cryptocurrencies being brought out and traded and showing such wildly high prices, he decided to create a joke coin called the Dogecoin with the symbol of a dog on it. So it's really a dog coin, but he called it Doge because he wanted to make it a little more respectable. And he said it is the asset of the year because it is a reflection of our era. When millions of traders can join forces online to push up the prices of joke cryptocurrencies or meme stocks, which we won't talk about here, it alters the meaning of value. What is the real meaning of value? If jokes can carry such ridiculous valuation. So in his view, that phenomenon is arguably bad for the world. I bring it out only to tell you that the opinions about cryptocurrencies vary all the way from proselytizers through skeptics and people in between who are bemused. Ray Dalio, the investor, is in the bemused category. JP Morgan's Jamie Dimon is in the skeptic category. And in between are people, as I said, like Ray Dalio. The great proponents and proselytizers are people like Tesla founder and Peter Thiel and those. I think Ajay is in the middle camp from a note that I saw of his that he published recently. So he's not on the skeptic side and he's not yet convinced. I think he's in the middle, probably moving towards convinced. But anyway, sorry, Ajay, it wasn't a hit at you. It was just to point out somebody right in our midst who can be characterized in that spectrum. Next slide, please. So the question I want to leave with you is, what's the future going to look like? And one thing you can say, as they say in China, may you live in interesting times. Certainly interesting times are ahead as the world transitions to digital currencies, and especially central bank digital currencies, whenever that happens in the next decade, 2 decades, earlier, whatever. And the question that I want you to think about is, will international commerce and investment hugely grow like it did after the Bretton Woods Compact? Because this is now this easily transferable, widely usable, essentially making most countries have open current accounts. Or will we have more of the Bangladesh robbery type of raid. Let me move to the next slide just to illustrate what the Bangladesh robbery was. Okay, this happened in 2016, and it involved transfers of close to $1 billion. And it was a cyber heist that was done using the SWIFT network by a bunch of hackers who were illegally transferring close to $1 billion out of the Bangladesh Reserve, the Bangladesh settlement account with the Federal Reserve of New York. They didn't entirely succeed because of two things. First of all, the SWIFT connecting bank and the bank that was handling that transfer the transfers involved multiple countries, a bunch of transfers over to Sri Lanka. And Deutsche Bank was handling that. And they suspected something strange. And they reported it. And as a result of that, that amount could be retrieved. That was like something like $20 million. The Federal Reserve of New York itself got suspicious and blocked about $800 million. And of the balance, approximately $101 million minus the 20 or so that they retrieved from Sri Lanka was lost. It was lost in the Philippines. They never got it back. And the reason I bring that up is that was a centralized system, yes, not distributed. And so it had the negatives of centralized systems, but it also had the positives. Because there was control and vigilance by Deutsche Bank and Federal Reserve of New York, most of this transfer could be stopped and the loss was greatly restricted. In the cryptocurrency market, all transfers are irreversible. They can only be reversed by the recipient. So this wouldn't be possible. So that's something to consider when you're going to go to digital currencies all around the world. Could you go back, please, to the previous slide? The other thing we have to concern ourselves is a massive breakdown in the monetary system or in the trade process. Like the Maersk attack. Could you go 2 slides forward? Next slide and the next after that. Yeah. So this happened in 2018. And as you know, Maersk is one of the largest international shipping companies, Moller Maersk, a Danish company. They handle about 20% of the world's containers, entire world's containers. But they were hit by ransomware. And that crippled ports, paralyzed companies, froze government agencies in the UK. And everything came to a standstill that was dependent on the Maersk and the software that they used, because it was what they call a supply chain attack. It took them 10 whole days to reinstall all of their servers, their PCs, the applications, and come back online. For those 10 days, all matters relating to trade and government agencies that were using the same software that was in the supply chain, everything froze. Now, if we can imagine this is done to the monetary system, that means people can't get access to their money, and it can go on endlessly. It also lends itself to crypto war, cyber wars. So that's another fear we have to worry about. Back to the 2 slides. Yeah. So cyber wars then become a coup de grace mechanism, that you apply that coup de grace and the country is completely broken and becomes your slave. And of course, as was used very much in the Iraq wars, there are all the unknown unknowns beside the known unknowns. So there are other things that we can't even at this moment imagine. So there's a lot to think about and a lot to worry about. And I'm going to leave it with you to think about, because everyone needs to think about it before we can start addressing them. Thank you.
Thank you. Dr. Shah, you're muted.
Thanks, Dr. Hebalkar. Shubhashish, you're tight on time. You want to change course. How do you think we should handle this?
So what I'll do is I'll just raise some of the issues.
Sorry for that.
And then we can go directly to Q&A on those issues and on what Dr. Hebalkar said.
Yeah.
Looks good. Okay. So the first thing I want to highlight is what Dr. Hebalkar started with, which is the issue of trust. And since if we think about the monetary system, there are two parts to it. One is, of course, money, and the other is the payment system, right? And so as long as these two, and since, Ajay, you talked about gold at the very beginning. Could gold be substituted by digital currency? Well, at least some people like gold, right? Unless you're a Midas, there is very little, how should I say, there are very few people who would just, love to finger cash or fingered digital currency or whatever you want to call it in place of fingering, right? So in that sense, money really has no utility value, as we say in economics. It's essentially an instrument which helps you to get value. And that's the reason why this instrument has to be accepted by all. And that's the issue of trust that Dr. Hebalkar was referring to. So I'll leave it at that. So the question that we ask ourselves is, can this currency, digital currency, generate that trust? Now, the one thing that Dr. Hebalkar also said is central bank digital currencies, right? So clearly the issue of trust is being directly addressed there. So the next question that you ask is, why are we going through this process? And there, I think there is a very, very important issue to consider, in the sense that the cost of non-cash payments as we have now is very high. In fact, it's pretty high. It's high in the sense that it is higher than the transaction costs of cash payments, right? So non-cash payments, when it comes to customers or the economy, is really not of value to them. It may be value to somebody else. It is easier to track the transactions and all of that, but it's not value to the people who are, or does not increase value to the people who are making those transactions. So in that sense, any technology that reduces this cost of transaction is to be explored and welcome. Okay, so that's the second point I want to make. The third point I want to make, and this is also important, is that depending on how the central bank digital currency, since I'm talking of trust, if there are other ways of getting that trust, that's fine. Today, it is the central bank digital currency which clearly addresses the trust issue directly. So if we are talking about that, it creates another problem. And that problem is, how is this going to be, or what is this going to be based on? If it is close to cash, as citizens, we like that, because privacy, what transactions you're making, with whom we're making transactions in cash, is known to us and no one else. And therefore, if the digital currency can be based in that fashion, it would obviously be better than if it is not based in that fashion. So, and that we talk about account-based or token-based. Token-based will be closer to cash. Account-based means the data would be followed by somebody, which is not the parties to the transaction. And that's an issue of concern today, given the issues of privacy, security, and all of that, and the debate that is going on everywhere else with data, because this would give rise to huge databases on people with agencies which are not party to the transactions. And the final thing I think we should discuss is what would be the role of the banks. Because you can have digital currency at the wholesale end, or you can have digital currency for the retail end also. And therefore, how you divide up or how you create these tiers of the system are important. So I think I'll just raise these issues and then we can have discussions on them. Yeah.
Dr. Hebalkar, there are many, many fascinating questions coming up in the chat window and in the Q&A. They are all sophisticated, well thought out questions, and you are looking at them, and I'm perfectly happy if you will go off in any of those directions and into the things that Shubhashish just said. So what would you like to do in terms of responding to all this?
Dr. Hebalkar, you're on mute.
Sorry, I'm unmuted now. I said one of the questions asked about CBDCs and why so many countries are looking at them. I thought I covered that. This cathedral and cryptocurrency bazaar analogy I have to think about. I haven't quite caught the analogy. Somebody made the comment that the Bangladesh heist was likely a North Korean advanced persistent threat. Yes, it was. It did involve an insider. The North Koreans were suspected. It is also said there were some Chinese individuals who facilitated in the withdrawal at the other ends. But the point I was making is that because the entire transfer took place through a relatively centralized, monitored switch, the controls to prevent misuse largely worked. Whether they'll always work, we don't know. One of the motivations behind the internet was by having this distributed connectivity, it was meant to protect the defense systems of the US from an attack on any one particular point. So it was the subsistence, the resilience of the network that was the objective of that. And the distributed cryptocurrencies do give you that resilience benefit, but because the process is irreversible, every transfer can only be reversed by the recipient. If there are crooks involved, you can't expect them to reverse anything. And monitoring from the point of view of the social concerns that we have, like money laundering or support of terrorism, these become almost impossible because of the anonymity. So that's really the issue now. So the Bangladesh example was given only to illustrate what the benefits of the centralized system are relative to what the benefits of the distributed one that we talked about in the presentation were.
Dr. Hebarkar, I would like to come back into that. The people on the crypto side of the fence will say that we have given you the complete openness. Our source code is in public domain. Our systems are in public domain. Everything is accessible. There's no security through obscurity. And there are no name, password type barriers to access. So we are actually the ultimate level of high security in the way that conventional, more cathedral models can never even dream of matching. So, for example, in Bruce Schneier's book, Applied Cryptography, he makes the analogy that if I put a secret in a safe and I hide the safe in upstate New York, that's not security, that's obscurity. If I put a secret in a safe and I give you the safe, I give you an identical open safe, I give you the engineering design of the safe, and still you are not able to get into the safe, that is security, which is what the cryptocurrency people are doing.
Okay, 2 or 3 points here. As I said, the strength of the cryptocurrency is the complexity of the crypto algorithms that encode the data. And they're all designed to be verifiable relatively easily, but extensible only with considerable effort. And in fact, the proof of effort is one of the devices that is used to authenticate whether the record that you're looking at is genuine or not. And that's often reflected in the number of leading zeros in the hash. So that's certainly an issue, an advantage over there. But the situation you have is there are 2 or 3 things. One, you have to have a public password because the entire exchange takes place on private and public keys. So the public key has to be made available. You need to have an identifier, which is the network ID. So it's not entirely anonymous, but because the ledger is encoded and it's hard to break, for somebody to read every record is hard. They can verify whether it is valid or not. And it is irreversible. So all of these make any errors to be corrected, whether deliberate or fat key errors that have made the news in trading losses, is a concern for anybody who's dealing with large sums of money. Now, Subhashish referred to the question of whether they should have wholesale digital currencies or retail digital currencies, whether the wholesale should be between banks, but not at the retail level and the other way. He's aware, and I can make everyone else aware, that the Bank of International Settlements report that talks about digital cryptocurrency, digital central bank digital currencies, talks about this dichotomy and what are the benefits of each of those in terms of control, whereas in terms of practicality of use. The current algorithms for Bitcoin are rather long-running unless you have lots of massive parallelism, very heavy computing equipment, which is why 50% of the mining of those coins has taken place in China, in the Western regions where they use solar power and can install large server farms to do that. Not every country can afford that. So then you can again have to depend on somebody else, like we currently depend on some of the large international banks for transfers. So some of that dependency comes in. So some of the advantage that you're claiming is fictitious, some of it is real. The other thing is scale is not clear. The scale of the international money in circulation versus the cryptocurrency in circulation. It's not clear that all of those mechanisms that are there in use for cryptocurrency can scale in the same manner. I'm not saying it can't be. I'm saying these are all imponderables.
Shubhashish, you are time constrained. Shall I ask you to tell us what is running through your mind as you hear all this?
Well, one of the questions I saw is, should one look at CBDC seriously, right? So let me quickly put it this way. You know, as I said, this technology allows you to reduce the cost of transaction, right? Proviso, what Dr. Hebalkar just said, in terms of the back end that you need to be able to keep these things going. But the marginal cost of a transaction is very, very low, where the marginal cost of a transaction is quite high in other non-cash methods. Okay, so that's one thing. So that's one reason, and plus the trust. But the thing that we have to remember is that why are we using this technology? We are trying to use this technology given our priorities. Now, for India to look at CBDC, one of the important things that we have to aim for, something that we talk about all the time, is financial inclusion. And there are instances where various forms of digital currency in, I forget the names in one or two places in the world, especially in Africa, where they have been used to actually improve financial inclusion. So if we are to readapt this technology towards getting that, I think CBDC could be a very, very important element in what we are trying to do. If we are doing it just because others are doing it, then we run into this problem of, you know, how should I put it, creating a new digital divide, right? That we have always been doing in our country when you try to follow policies. There are always people left out of the policy as beneficiaries, even though they should be, right? And even though that's what the intended purpose is, but nobody really cares beyond the point of the people who are being left out. And that is what I'm worried about, that this technology hoo-ha will be taken to such a level that we will forget to look at our most important priority that we are looking at in the entire monetary system, is how to ensure that everybody is part of the system. So that is the only point I would make. There's a huge opportunity, but we must think beyond what other countries are.
Can I just add a word?
Yes, please.
The sand dollar is an experiment at the retail level. And it's meant for day-to-day use. So it will provide a test bed for us to see what happens.
Yes. In other words, we should be looking for specific examples rather than in general to see which of those actually could satisfy our priorities.
Dr. Hebalkar, Shubhashish, are you going to sign off right now? Shall we say thank you and bye to you right now?
Yes, please, because my next meeting has started at 10:30.
You had told me it's a hard stop, so I'm just want to give you the mic and be sure that you've had a chance to be in this.
Thank you very much. And I'm sorry I have to leave for another meeting.
No,
My
thank you for
apologies
joining
for
us.
eating into your time.
No, that's it.
Thank
Okay,
you.
bye.
Yeah, bye.
Bye.
Thank you again.
Dr. Hebarkar, can we come back to you and continue? There are many, many things buzzing in the
Sure.
chat. Which one of them would you like to take a stab at?
The latest one says, after years of studying it, I believe that cryptocurrency is an inherently right-wing, hyper-capitalistic technology built primarily to amplify the wealth of its proponents through a combination of tax avoidance, diminished regulatory oversight, and artificially enforced scarcity. So the founder, same Jack Palmer of Dogecoin, said. What are my thoughts on that? I think that's a valid perspective. Certainly the motivation was ostensibly to make money transfers money democratic, but is there motivation to support the wealthy in terms of providing the anonymity, the means to avoid tax, and to avoid regulatory oversight, which currently is an issue in securities trading and commodities trading and so on? Yes, but that's, as I said, that's the view of the skeptics. The proponents and the proselytizers see only the benefits, and they see that as a democratic movement. And I'm in the bemused category. I watch it, I try and understand it, but I see the advantage of both sides, and I can't really yet take a position on it. That's all I can see here.
Yeah, my sense is both statements are true. Cryptocurrency can and will be used as political contributions to opposition parties in authoritarian countries. And we would celebrate that. That is great. Cryptocurrency will be used for doing more tax evasion. And that's an endless war of attrition, which will never end. So there's never going to be a comprehensive financial surveillance system. People will always try to avoid taxes, and that's just a part of life. So I see both statements are true.
I would agree. Any other questions?
Can I ask you to weigh in on some of the things happening in the Q&A? Ajit Ranade says that there are network effects in currencies, that currency is like English. Once enough people know English, English is unstoppable. It doesn't matter what the technical characteristics of the language are. In similar fashion, the USD is deeply entrenched in the world of globalization, both on the trade account and the capital account. So is there even a hope in hell for any of these Johnny-come-latelys to make a dent on the established position of the US dollar? Thinking about it in the language of network effects.
Well, network effects can work for China too, given that they have such a large share of world trade. The number of countries in which their goods are bought or sold, whether it's commodities or manufactured goods or whatever, and the number of transactions they undertake. If they were to insist on pricing them in yuan, because they don't want the exchange risk or the controls of the New York Fed on money transfers, eventually they will too have a network effect. Now, in that whole thing, will there at the end be 2 or 3 currencies? Yes, that's how it has been in the international system. When Bretton Woods was implemented, it was pound sterling and the dollar. Then it was pound sterling, dollar, and yen. Then it was Swissies. So currencies came into the basket, went out of the basket, and same thing in trade pricing and payments. So yes, there will be network effects that will make 2 or 3 of them leaders, and the rest will have to follow. But that's where the distinction between whether your digital currency is for local use only, which is what China currently envisages, which is what the East Caribbean Initiative does, which is what the Europeans are currently looking at to start with. That will still have value within the country. It's in international trade and investment that the same sort of dominance will take place with those couple of currencies that have the volume, the ability to grow that as trade grows and investments grow, and the network effects of acceptance.
Okay, we are now at 10:39 and we've already gone over by 10 minutes. So may I ask Shilpa to come back into this and close the proceeding?
Yeah, Thank you. Thank you, Dr. Shah. Thank you, Dr. Hebalkar. Any last words from our chair today, Dr. Shah?
No, I'm fine. This has just been a great discussion, and I've been merrily typing into the chat and into the Q&A. So basically, I've been talking in parallel while Dr.
We really
Hebalkar and
appreciate that
Shubhashish
because
were talking in audio.
there was a lot of food for thought, I think, going on parallelly in the windows. So yes, thank you. So thank you very much. This has been an enlightening and a fascinating conversation, I think. We've had so many learnings, so many takeaways. I want to thank our distinguished guests, Dr. Hebalkar from California. Again, thank you so much for joining us very late Friday, your time. Dr. Gangopadhyay, who also took time to join us in spite of having a packed schedule on a Saturday morning, and Dr. Ajay Shah for moderating this conversation, for engaging with our audience simultaneously, for keeping everyone so involved. You've given us many valuable insights on a subject that elicits much interest worldwide. Thank you once again. I also want to thank my PIC colleagues for all the hard work and the efforts they put in behind the scenes. This would not have been made possible without your constant efforts. So thank you. And last but not the least, many thanks to our audience for joining in, for your enthusiastic participation. We know it's a Saturday morning in India, late Friday in the US. So we thank you once again for being here. We hope you and many others will join future PIC events as well. Our forthcoming Adda on the 24th of July features Dr. Ajay Malshe, who will speak on social equity. Stay tuned, please, for further updates on PIC's social media pages. Once again, Dr. Hebalkar, Dr. Gangopadhyay, Dr. Shah, thank you, and we look forward to hosting you again in the near future. This concludes today's roundtable on the role of digital currency. Wishing our India audience a pleasant day ahead, and good night, Shubharatri to our guests joining in from California. Thanks.